ค่ะก็สวัสดีทุกท่านนะคะก็ได้เวลาของบริษัท PSL ในการนำเสนอข้อมูลของไตรมาสนี้โดยคุณคาลิดฮาชิมกรรมการผู้จัดการทางด้านซ้ายมือของดิฉันก็จะนำเสนอในเรื่องของอุตสาหกรรมการเดินเรืออัปเดตภาพรวมของการเดินเรือแล้วก็จะตามด้วยมิสเตอร์คุชูวาเดียกรรมการทางด้านการเงินก็จะอัปเดตในเรื่องของผลประกอบการแล้วก็ตัวเลขทางการเงินและท้ายสุดก็จะเป็นคำถามคำตอบซึ่งยินดีทั้งรับทั้งภาษาไทยและภาษาอังกฤษนะคะค่ะขอบคุณขอเชิญคุณคาลิดค่ะ
Sawadee krap everybody. Good afternoon. As usual, we will divide the presentation into two halves. In the first half, we will discuss the industry structure, and in the second half, we will look at the financials of the company in more detail. So if you look at the industry itself, you can see that pressure shipping is in the smaller size sectors and the geared ships in the dry bulk space. So please keep in mind, we don't carry any containers, nor do we carry any liquid cargoes. All we do carry are dry bulk commodities. This is a chart of the Baltic Dry Index from 1985 all the way up to the current time. And as you can see in the highlights, the market has been very, very strong in 2007 and 8, where it touched two peaks, both of which were in the high 11,000s. And then it has come down since then, and right now it is struggling at about the lowest point that we have seen on an annual average basis. If you look at the BDI on an annual average basis, 1986 used to be the old benchmark for the lowest point in the index, and the index had averaged during that year 715 points. As you can see, in 2015, it was almost equal to that, just 4 points above. And in the first half of this year, you can see that the average is at 490 points, or 489 points, and that is roughly about 50% below where the index used to be at the lowest point in 1986. So it gives you an idea as to how steep and how sharp the fall in the index has been. So what are the factors that could impact the BDI during this year and in the years to come? So if you look at China, China is the biggest player in the dry bulk space. So if you look at the items that I put up for you, you can see that China's steel exports in the first half of this year were running at approximately 10% above last year. So you can say China has done well in steel exports. In terms of iron ore imports, again, approximately 10% above last year. In coal, China used to be number one importer of coal in the world, still is about number one consumer of coal in the world, consumes approximately 3.8 billion tons of coal per annum, but they also have a large mining sector that supports that consumption. However, China has been slowing down their imports, and year over year, imports have been dropping quite sharply. This year, they were expecting that coal would drop by another 10% in terms of imports. But actually, if you see the first half results, China imported 8%, almost 10% more coal than last year. So again, China has done well in terms of all the imports that they do. If you look at the Brazilian portion of the iron ore, you can see that that has gone up quite strongly. And that's very important because Brazilian iron ore is about 4 times ton-mile intensive as the Australian iron ore. That means for the same amount of cargo, it takes 4 times the amount of time to travel between Brazil and China and back as compared to Australia and China and back. So more ton miles out of Brazil means better markets for us. If you look at steel production, that's the only number where China has sort of come down compared to last year. So there has been roughly a 1% slowdown in the production of steel. The other thing that supports the market is, of course, the very large scrapping that has taken place. Almost 23 million tons of ships were scrapped in the first half of this year. If you look at another support point, it is the number of mines that are being closed down in the coal area in China. So if you look at the first 6 months total of coal being mined in China, you will see that it is almost 10% below last year. And that is what is allowing China to continue to increase imports of coal, because the coal produced in China is of a lower quality, much more polluting than the coal that they can import, and also much more expensive. In terms of steel production, as I said, there is a 2% fall in the Chinese steel production. In terms of the other events that have taken place, Brexit, there are various analyses. I've just given you one of them. These analysts say that Britain or UK will actually just about save themselves from a recession this year because of Brexit. Prior to Brexit, the expectation was for 2.4% GDP growth in the UK. Now it's come down to 0.2%. And you must not forget that Great Britain is, or UK, is a very large economic power. It is just below China. So from that point of view, it's a large economy, and if it doesn't do well, it's not good for the shipping business. And then if you see for 2017, they expect the GDP numbers to drop from the prior expectation of 2.3% to post-Brexit of 1.3%. So it doesn't look good for shipping this event of Brexit. Similarly, if you look at the global economic activity, 1 month you get good numbers out of America and everything looks good and they expect to raise interest rates. The next month numbers look bad and then they say they will not raise interest rates. So the world economic recovery is very, very patchy and very, very volatile. It seems to go up in 1 month and then come down in the next month. China's slowdown is further exacerbated by the falling commodity prices, because as long as commodity prices are weakening, as a buyer, you will never buy a lot of commodity. You will buy hand to mouth, because you know that if you buy the next month, it will be cheaper than this month, then it is better to buy slowly. And that's what China is doing, and therefore there is no seasonality in the BDI. Similarly, there is the prospects of rising interest rates. Now, rising interest rates have got a twofold impact. One fold, of course, is that it means the American economy is doing really well. So that's good news. But it has a downside, that once interest rates start to go up, many industries around the world will start to suffer because the interest rates will go up and maybe they will not be able to manage, because right now there is an excess of supply in every possible industry that you can think of. And in our business, there is, of course, the question of oversupply. As I said in the previous slide, on the last bullet point, I said that scrapping has gone up substantially, so that is good news, but we still have a lot of excess ships and we need to reduce that. This is a pie chart from Clarkson's. It just gives you an idea as to what is the total tons available for dry bulk shipping per annum. Keep in mind, this is not actually this is the raw number for demand. Over and above this, you have to factor in ton mile changes. You have to factor in any congestion that there is and any slow steaming by the ship owners. So if you look at it, 2014 there was a 5% growth. If you look at 2015 on ton mile base, just on pure tons, there is no growth, but there was about a 2.5-3% growth in ton mile terms. If you look at this year, they expect a 1% increase in the total tons. But actually in the first half, as I showed you many of the numbers from China, in the first half, if you look at it, there is actually a 4% growth if you look at ton mile terms. Okay, so growth in demand is been pretty good considering the world economic condition. If you take that background and then you see 4% growth rate, it is higher than any GDP numbers that you see for any country. So it has done well for us. Demand has done well on the shipping side. If you look at asset values, and if you were to compare with the last big downturn that was 1985, 1986, 87, and see what's happening today, you can see that asset prices are still falling. And they have reached the lowest point that we have seen in Q1 of this year. So we expect that from here onwards, asset prices will stop falling, and they have already started to rise. Between Q1 and Q2, there is between a 10 and 15% increase in asset values, and we expect that asset values will now become more linked to what happens to the BDI. They will not fall any further, and we might see a gradual rise in both the BDI as well as the asset values, provided ship scrapping continues at a good pace. If you look at operating expenses, this is the big change that we have seen in between 1985, 86, 87 and the current period. In the current period, costs were going up all the way up to 2015. And for the first time, we are seeing that there is a gradual reduction in cost in 2016. Anyway, keep in mind, this is only the first half of the year. We have to see the numbers by the end of the year. So based on first half numbers, it looks at least that the increase in costs has now tailed off. So which is again good news for us. In terms of earnings per day per ship or time charter rates, you can see once again that rates continue to fall and have reached probably the lowest point that we have seen. If you look at the supply side and look at the upper half of the graph, upper half of the slide, you can see that totally there are about 10,840 ships. The average age is less than 9 years now, so it's a very young fleet. And the total deadweight tons as of the end of the second quarter was 778.41 million deadweight tons. The average size per ship is now almost 72,000 tons. If you look at the lower half of the slide and look at the last column, you can see the change that has taken place in each sector of the dry bulk market in terms of deadweight tons as well as in percentage changes. So if you see that, you can see that we have added almost 1% net between scrapping and supply of new ships. We have increased the fleet by almost 1% in the first 6 months of this year. After the first quarter, we felt that there would be negative growth this year, and if scrapping had continued at the speed of the first quarter. But if you remember, in our first quarter presentation, we showed you that scrapping had reached almost 14.5 million tons in the first quarter, and now it's reached 22.74 million tons. So therefore, you can see scrapping is at roughly half the level in Q2 as it was in Q1. And that is because rates started to go up. The BDI was at its lowest point in February of this year, in the middle of Q1. And therefore, Q1 showed the maximum scrapping rates. And as I said, for the BDI to continue to recover and for asset values to continue to recover, we need scrapping to go back towards the levels that were achieved in Q1. If that doesn't happen, you will find that the BDI will start to fall and may even go back to the levels that we saw in February of this year. In terms of the balance orders still to come, you can see that we still have for this year roughly 7% more ships to come. Next year another 4%, and thereafter the new building orders drop down to almost zero. If you look at the amount of ships ordered in any 1 year, you can see that when the markets were very, very high, in the high 11,000s, 2007 and 8, you can see that they were outstanding years that ship owners started buying and ordering a lot of new ships. Similarly, in 2010, post the Chinese government's fiscal and stimulus that they put into the market, they had used $586 billion of infrastructure development to be put in place by the end of 2009, and that pushed the freight market from a low point of 666 points in December of 2008 up to a high point during 2010 of almost 4,200 points. So that made ship owners again go crazy and order a lot of more ships. Then 2011 was a weaker year, and you can see that ordering came down. Similarly for 2012. And then in 2013, in the second half of the year, things started to become very good. And as a result, the BDI went up and people went crazy once again and ordered a lot of ships. That was a false dawn. And as a result, 14 and 15, you can see how the ordering has come down. And I can tell you in 16, there is actually nothing being ordered. So these are good news now that we have, that people have realized that the market could stay down for a longer period than most people had anticipated. Therefore, people have to be more careful and not order so many ships. If you look at scrapping, if you look at the 1983 to 1989 period, you can see that in 1986, maximum amount of scrapping took place. The skyscraper there, of course, is much smaller than the skyscrapers that you have in 2012 and in 2015. But if you look at it in percentage terms, the 1986 skyscraper, though it looks quite small, was actually in percentage terms almost 5% of the existing world fleet at that time. Whilst currently, even though the skyscrapers are almost 2.5 times as high as they were in 1986, they are roughly about 3% of the world fleet. So we need much more scrapping to take place for us to come back. The second thing to notice is, of course, the quality or the age of ships being scrapped. In the mid-1980s, the average age worked out to 15 years. Currently, the average age is still struggling at the more than 20 years of age. It's around 23 years of age for 2016. It was 24 for 2015 and 25 for 2014. So average age is coming down, but slowly. In terms of the slippage, that is the difference between what is expected to be delivered in any one year and what is actually delivered in any one year, you can see that the slippage factor has been going up and is inversely related to the freight market. So means if the freight market is good, slippage is low. If freight markets are poor like they are now, then slippage is very high. So currently we are expecting slippage to be at somewhere between 50 and 60%. So if you were to take a 50% slippage factor and you were to annualize the first half scrapping numbers, then this is what you would see in terms of net growth in tonnage in 2016, about 1.5%. And in 2017, if you applied the same type of conditions, then you would see a negative growth of almost 2%. So depending on scrapping, a lot can change in these numbers in Q3 and Q4. Q3, we don't think scrapping will go up in any significant way for two reasons. One is that the rates on the BDI have gone up, and that is encouraging owners to hold back from scrapping. Secondly, scrap prices are at a fairly low level. And the third most important point is that the scrap yards in India, Bangladesh and Pakistan currently are under their monsoon season. This is their monsoon time, and as a result they cannot really buy ships for scrapping. It's very difficult to cut ships up when it's raining. So that is the reason why Q3 generally is a very low number in scrapping terms, but we expect Q4 to pick up significantly. Again, in macroeconomic terms, just to recap, America remains the one bright spot in the world economy. India is the second bright spot. They are the amongst the larger economies. They are the ones that are have a GDP number in excess of 7.5%. And the third factor, of course, is oil. Oil prices coming down should give a transference of wealth from the oil producing nations to the oil consuming nations, and this will be like a get out of jail free card for many of these countries, including India and China, which import a lot of oil. So their cost for imports will come down, and as a result will allow them to use their fiscal budgets on other items. and therefore they can try to stimulate the economies, just like China is doing as we see today. Of course, the overall GDP for the world is poor. The IMF keeps revising downwards every time that they make a new economic prediction. It is always lower than the last prediction. And that is because at the beginning of the year, they are optimistic. They feel the world is coming out of this long recession. And then by the middle of the year, they feel that, no, we've not yet come out. And then they revise the numbers downwards. Similarly, for Europe, it's been a long struggle for them, but they still seem to be in a bit of a mess. And now with Brexit coming in, it has sort of upset the European apple cart even more so. Abenomics, or the Japanese economy, is in between. I mean, if you read the latest Economist, it gives you a very good summary of what has done well under Abenomics and what has not done so well. And one of the things that Abenomics was trying to achieve was a higher inflation number. The problem with Japan, when you look at inflation, is that they include energy cost into the inflation numbers as against any other country where they don't have energy costs included. So if you were to exclude energy costs, then you would say that in the first 6 months of this year, Japan has actually had a 5% increase in the inflation numbers as against what it would have been if there was no Abenomics. So Abenomics has had some results, and it's only a question of seeing how far this effect will push up their consumption behavior in Japan. In terms of China, again, just to give you some hard numbers, GDP numbers running at 6.7% per annum. Iron ore imports, as I said, is roughly about 10% above last year at the halfway mark. So if we annualize it, again, you'll see the same type of total. Similarly, with coal, we have done better than what we expected. Actually, we should have had a reduction in coal, but so far the first half has been good, and we are just annualizing those numbers and showing it to you. Steel production has been slightly lower than what we saw in the first half, so we might end up with the year at being at slightly better than because the first half in last year was very strong, second half was weaker. If you see steel exports, it is running higher than last year, and as a percentage has remained roughly the same as from their production base. In terms of iron ore imports, as I explained, Brazil's export of iron ores is very important because it is 4 times as intensive ton-mile wise compared to Australian exports. And therefore, it's important for us to see that the numbers from Brazil start to increase. And that's what we are seeing so far into the imports of China. In terms of railroad, China is planning and has already put in a lot of stimulus to try and get their railroads in place. One of the things that they're really working hard on is on the One Belt, One Road, and that is going to show you a lot of increase in the railroad space that they are trying to increase and build on. So during this period of time, what has been the strategy for pressure shipping? It has been to expand the fleet, sell off the older ships, and try to fix the ships on longer term contracts once the market improves. This is a snapshot view of the assets of the company. So if you look at this, you can see that we expect by the end of next year, when all our expansion program will have been completed, that we will have 38 ships with us, and that the average age will be about 7 years old, and that the average size will be about 43,000. So we have been quite successful in what we have been trying to achieve, trying to get the company into, as the assets are concerned, into better shape. So just to show you in a pictorial view that this is what the company's assets look like in the past on the left hand side of the screen, and this is what it will look like once the expansion program has been completed in 2017. In terms of the risks and opportunities in shipping, it's the same. The golden rules are not to buy any assets in the higher markets. Now this is something that we've been very good at. We've been very patient, and we've been buying ships only when the markets have been lower. sell ships at the high points of the cycle. We've done that quite successfully in the past. On this last cycle, we have not been as successful. We should have sold a little bit earlier. We thought the markets would improve in 2013 and 14 and we would sell it at that point of time. And that's not happened, and now we are selling the ships anyways, and so we are not able to achieve the type of numbers that we had hoped to achieve. Obviously, you should not speculate in any way. We don't have any form of speculative instruments in our balance sheet. So what you see is what you get in terms of our balance sheet. Obviously, we would like to fix ships on long-term contracts. We currently have 7 ships which are out on really long-term contracts, and these ships are helping us to keep our average numbers above the index numbers. Obviously, you should try to deleverage your balance sheets during the good times and leverage your balance sheets during the bad time. And this is the bad time, so we are trying to increase the leverage in our balance sheet such that we can take advantage of the low price asset prices and buy ships from the leverage effect. Obviously, dividends can't be paid during times when you're making a loss and when you have debt on your books. So we have stopped paying dividends, but we had a very long continuous quarterly dividend payout record in the past. And obviously the last rule is to buy ships at the bottom of the cycle, and that's what we have been doing. So this is the pictorial view of the time when we bought the assets as compared to the blue line, which is the Baltic Dry Index. So when the markets were low, we had bought the ships. When the markets were high, we have sold the ships. Now you can see the same thing. We have added a lot of ships, and now we are waiting to complete the expansion program. In terms of the earnings per day per ship versus the Baltic Dry Index, as long as you have ships out on longer term contracts, you can beat the market expectations. That's what we've done quite successfully in the past. If you look at the current forward book, as I said, we've got 7 ships out on long-term contracts. So these numbers will not change for some time. They will just be the same roughly in terms of the number of days that have already been prefixed. And the rates at which they have been done, as you can see, is the black line. It gives you a very good idea as to how well we have fixed the longer-term contracts. In terms of market segmentation, as I said, this is where the impact of the longer-term contracts comes into the balance sheet. You can see that on the Handysize index in quarter 2, the index level was at 333 points, derived from a time charter, average time charter rate for that quarter of 4791. Against that, our charter rate was 6752. There's no magic in this. It is mainly the long-term contracts that have helped us to outperform the market, and we've outperformed it by 41%. So we have more long-term contracts. Out of the 7 ships, 6 ships are in the smaller sector, which have got long-term contracts. And we only have 1 ship in the larger sector, in the Supramax sector, which is on long-term contract. So here you can see out of 554 index points, derived from a time charter rate in the second quarter of 5,795 points. The average for the PSL fleet was at 5,571. So we underperformed the index marginally. Now Kushu will take you through the balance slides covering the financials of the company.
Looking at our new buildings program, so we now have 5 open contracts left with Sanfu. As you know, we had 10 with them. Out of the 5, we have cancelled 3 of them, and 2 ships have been delivered. Now we have 2 more ships to be delivered this year and 1 more in early part of 2018, which means that out of the 10 contracts, 5 ships would be delivered finally from Sanfu shipyard and 5 would be cancelled, and these are all amicable cancellations. So we have got refunds, or we will get refunds as and when the contracts are cancelled, along with interest right from the day the advance installments were paid. The situation with Saint Shipyard is slightly different. Here we are in litigation. So as you can see, out of the 14 contracts, only 2 ships were delivered. 10 have been cancelled. 2 further ship contracts have been cancelled from the shipyard side, which has been disputed by us. But in any case now, by the end of this month, we as buyers would also proceed to cancel those contracts. So in a sense, all the 12 contracts would be cancelled. Only 2 have been delivered, where again we are in litigation with them for some warranty claims which we have made against those 2 ships. And we have up to now advance or installments paid of about $64 million on these contracts. As and when the arbitration results sort of come out, the arbitration awards come out, based on that we would get the refunds, or we may not get the refunds, or we will get them partially. It would depend on the arbitration awards. This slide gives you some of the highlights, mainly as we saw in Q1, which was the low point in the market, where the Baltic Dry Index reached an all-time low. At that point, in that quarter, for the first time ever, we had negative cash earnings or negative EBITDA. So as you can see, we had about $1.5 million of negative EBITDA. This was based on about $4,800 of time charter rate and an OPEX level of 4,500. These are the 2 numbers essentially which will give you the EBITDA levels as well as the profitability levels. In this quarter, since the markets went up, our earnings have also gone up, and from 4,800 we reached an earnings level of about $6,300. OPEX being, operating expenses being nearly the same. That has resulted in a multiplying effect on the EBITDA levels, where now we are back again to positive EBITDA of about $4 million is what we had in terms of our cash earnings. This therefore resulted in our earnings per share, excluding the non-recurring items. We had a loss on sale of 1 ship, plus we had to take an impairment on 1 ship, which we will sell during the course of this year. Excluding those non-recurring items, our earnings or loss per share was 0.22 baht, which actually, as you can see, is slightly lower than what it was in the second quarter of last year. And the reason being that in this particular quarter, our earnings level of $6,300 was actually better than what it was even in the second quarter of last year. So this quarter, in a sense, has been a good quarter. Relatively speaking, of course, we still have a loss, but that is lower than what it was in the first quarter as well as what it was in the second quarter of last year. If you look at our financial position, which is on the big difference here, as you can see, as compared to what it was in the end of last year, is that our cash balances have gone up substantially, and this is as a result of the debentures which we issued of about $100 million. So we issued $100 million of debentures during the early part of this year and utilized some of the funds received to prepay secured debt. So therefore, secured debt, the loans from banks have actually come down. So we increased debt by $100 million, but if you look at total liabilities increased by only $30 million. So we have used our funds, cash, prudently enough. We have not gone around spending it on frivolous items, on doing anything else, but mainly to reduce debt and to use for the negative cash flows which we have on the operating account. And we tried to ensure that we do not default on any of our loans with our secured lenders, with all our banks, and which is very, very unique in the industry today. Practically every dry bulk ship owner has defaulted badly or is discussing restructures and serious waivers of repayments or interest payments with the secured lenders. We have not done any of that. We have not defaulted. We had financial covenant defaults, but these have been waived. There's nothing to do with payment defaults. And this we have been able to achieve by raising the cash whenever required so that we do not default with our secured creditors, with our banks, as well as with our trade creditors, which is also what has started happening in the industry today. This gives you the operating expenses, which, as you know, these are fixed expenses incurred on the ships. They are incurred irrespective of whether the ship is earning money or not, whether it is in a dock, whether it is being repaired by and large. So this is spread out over a 365-day period for each ship. And our operating expenses are showing a slight reduction trend, mainly on account of the fact that we now have younger ships as compared to the past. So because of that, our operating expenses are now 4,500. In any case, if you look at the next slide and compare our operating expenses with that of the industry based on a particular survey report which comes out every year, you will see that pressure shipping's operating expenses are anywhere between $1,000 to $1,400 less than what they are in the industry on a very consistent basis year on year. And that was the case even in 2015, where pressure shipping's operating expenses are lower than what it was for the industry. The next one gives you a pictorial graph which indicates all the time a consistent performance of about $1,000 to $1,400 less than the industry. This is one reason and one way that it allows us to weather the storms, to go through the storms, go through the down cycles in a much more healthier way than compared to our competitors. Because if they have operating expenses which are higher, their break-even levels are to that extent higher, and therefore they will get into trouble much earlier than what we would do in a down market. This slide gives you, right from 1995, the figures of the first chart. The first bars give you the average age. So if you look at our average age of our fleet, we had a peak in the year 2007, 2008, and within those years we had a peak level of about 22 years of average age. So in our lifetime of pressure shipping, that was the highest or the oldest age of our fleet. Those were times when the markets were very, very high. So it did not matter whether they took or required more expenses, and therefore the operating expenses also during that time, if you can see the lowest line, the graph line, the operating expenses were also at their highest level. But it did not matter because the TC rate or the earnings were also very high during that time. So that was the peak of the market. Thereafter, if you see the age, we are now at our youngest age. So we now have a fleet which is young and big enough. Our average size of each of our ships is about 40,000 deadweight tons. The average age is under 8 years, and the as you can see, the operating expenses are also at a very low point level of $4,500. So in a sense, we are now well poised that when the upturn comes, we are ready to take advantage of that upturn and do very, very well. This is the historical position of how our debt and debt equity ratios look like. We reached a peak level during the Asian financial crisis during 96-97. Since then, we dropped up, we came down, we reduced debt, and during the peak periods of the peaks of the markets, where we were earning a lot, that time we reduced debt to near zero levels and actually zero levels in 2006 and 7. Thereafter, we started our expansion, and that expansion has been mainly through debt. We still are at a level which is about 1.1 times the equity. So we are at a very, very healthy level, particularly in the shipping industry, where debt to equity levels could exceed 2 times also. In terms of funded debt to EBITDA, of course, this looks a very sorry picture, but bear in mind that EBITDA, meaning cash earnings, are at negative levels for most companies. So even to have an EBITDA is a great achievement. And as I said, we in the second quarter, and if you look at the full first half of this year, at least we had some positive EBITDA, while almost all of dry bulk shipping companies in the world are struggling with negative cash flows. The next slide gives you the operating profits and the cash profits. Once again, as you can see, the cash operating profit, which is after interest. So this is not EBITDA minus interest. So after you reduce the interest, it was only in this 15 and 16 years, that is in the last 1 year has been the year where for the first time ever we had negative cash profit, or in other words, negative cash loss. Same is the case in if you look at net profit or cash profit, this would include, of course, extraordinary gains and extraordinary losses. Once again, after you included this non-recurring items, we can see that 15 and 16 have been sort of landmark years where we have actually lost cash even after paying out interest. So the interest cover, in fact, has reduced, or it has come down to lower than 1 for the first time ever in the history of pressure shipping. As I said, dividend policy, we had a very, very consistent record of paying dividends in the past a couple of years back, where we were paying quarterly dividends for over 7.5 years continuously. Since then, markets have turned, and obviously, right, as of now, there's no question of paying dividends. If one were to look at how we are now compared to the last 4 or 5 years, we are, in terms of earnings, at the lowest point, but that is the reflection of what the market is like. In terms of the earnings, in terms of the freight rates, the market is at the lowest point ever in the history of the dry bulk shipping. However, in terms of financial strength, we are reasonably good. We still have decent equity in place. Our debt to equity levels or debt levels, leverage does not look all that bad. So we are reasonably healthy and strong. We continue to receive awards and for our achievements. So lately, few months back, we were the recipients of the Sustainability Award from the SET. We continue to receive awards for corporate governance. We continue to remain 5-star, have a 5-star rating from the IOD, from the stock exchange on all matters of corporate governance, including investor relations. And so this is something which we do not lose focus on, whether the markets are good or bad. This is an area where we continue to try and do better and improve, or do better and challenge ourselves to do better than what we have been, in spite of the fact that we are literally among the best of the best in this area. So we have listed out a few awards, and then of course we have got other awards in industry, in terms of we've been the finalist for the dry bulk operators. We were the winner of the Security and Safety Awards recently. This is once again a sort of snapshot pictures of our Marine Money rankings, our other awards from the Asset magazine in terms of corporate governance in Asia, where we've been ranked among the top, absolutely the number one in Asia for corporate governance, things like that. Marine Money, as you know, comes out with a ranking every year. Given the state of the dry bulk market, we have slipped down. This is a ranking of all shipping companies, which are listed, of course, all over the world in every sector. So not just dry bulk sector, but in tankers, containers, cruise, everything. For this year, our rank has slipped down to 74. Considering that this is how it has been, the dry bulk markets have been very, very bad. But if we looked at the dry bulk shipping companies alone, which out of this particular size, the sample, the population of this shipping companies for whom the rankings were done, if you looked at that and took out the dry bulk companies, we had 18 which were ranked, and out of the 18, pressure shipping was ranked 8. So you could say somewhat in the top 40%. However, we are looked at very kindly, we are looked at with great appreciation by our peers, by our regulators, by all other associations, institutions connected to shipping. So Marine Money being one of them, has come out with these kind of appreciative words in spite of the lower rankings which we have achieved. We do an analysis of shareholder returns. Lately, of course, shareholder returns do not look all that good. But if you looked at it over the long term, or if you looked at how it was, if you had invested in the IPO in the year 1993 and looked at the share price as well as the dividends what you would have got, the returns would have been in the region of 10 times. So 10 times in 23 years is a decent return which the company has provided its shareholders in spite of the very, very low levels which we are witnessing right now. Now, if you had not invested in 1993 in the IPO, and if you had invested in 95 or 2000 or such years, once again, in practically all of these instances, you would still be at better or at par, except of course if you had invested in 2010, which was a sort of a peak level. So at that time, we were very close to the peak. So the share price was about 20 baht. At that time, today of course, the returns don't look all that good. But this, once again, even if we say that your investment value has become 50% if you had invested in 2010, if one were to do a comparison of similar investments in dry bulk companies in the world with similar timelines, probably even this 50% would look anything between 5 and 10 times better than what it would be for other companies. With that, we close the presentation and throw the floor open for questions.
ค่ะถ้าท่านไหนมีคำถามก็สามารถสอบถามได้เลยค่ะค่ะเชิญค่ะ
Mr. Khalid, most respected Mr. Kusavadia, I have one question. Most of the time you are buying new ships as a replacement of old one. Whether you are adding fresh new ships without replacement means you are having very strong financial position in the past. Have you added some additional fleet without replacements?
If you look at the numbers, at the peak we had 54 ships. We are expecting to be down to 38. So obviously, whilst we are adding ships, we are also subtracting ships. We are removing the older ships.
Another question is that your gross profit you are maintaining intact in every year of your up and downs. So the main situation comes to the gap between net profit and the gross profit. Whether you are concentrating more on variable costs to have more than the fixed costs. This is a new trend in Fortune 500 companies in the world. Any cost you are incurring in future, they are putting more towards the variable instead of the fixed one. What's your point of view and insight?
Well, actually, gross margin is not maintained. Gross margins go up and down based on the earnings levels. That is based on the top line which we achieved. Expenses are more or less fixed in terms of operating expenses, and which are by and large around the $5,000 levels if you look at even the past 20 years for us. So actually gross margins do go up, and in fact there is a huge operating leverage working here, and that is the reason why net profit goes up dramatically when you have changes in the top line or the pricing. So in a sense, I wouldn't agree that net profit is driven more, is not driven by gross margin. It is purely driven by gross margin.
And in terms of cost, we are already at a very low level of variable cost. So we don't think that we can, or rather fixed cost, we can't really reduce this too much more than what we have. As Kushu explained in the presentation, we are about $1,400 to $1,400 cheaper than our competitors.
What are the new innovations in the world in this scenario you envisage so that the bottom line can be in the positive territory very soon? Because you say every ship is running at the losses now. How long they will be carrying, because export import will be there universally with among all the countries. One country cannot produce everything. They are dependent on others. If ships are running at loss, if they stop carrying goods, what will happen in the future?
If ships stop carrying goods, then the markets will go up. So if enough ship owners decide that collectively we will say we don't want to carry the goods anymore because its pricing power is so low, and we refuse to carry at this low a cost, then if they say we refuse and we put the ships into like mothball them and wait for the markets to go up, then of course the markets will go up. I mean, this is a very easy thing. Though the problem with this is that you cannot collude. You can't have collusion between suppliers of any service or goods where you try to come together and form a cartel and try and push pricing up. So that'll be illegal. So I don't think we can do that from a legal point of view. Secondly, and more from a practical point of view, the industry structure is so fragmented in ownership that you will never be able to get consensus and get people together to do this. So let me put it this way, in a very simple zero-sum game, if you were to lay up your ships, the market will go up and I don't have to lay up any of my ships and I will get the benefit of it. And that's how people think in this market, and therefore to get consensus and to get people to coordinate their actions is difficult. The only way where you can get relief or get the markets to improve today is, we think, from the supply side contraction. So therefore you need more scrapping of ships. So here there are quite a few companies that are being very responsible. So like for us also, we have sold many ships. So far of the ships that we have sold, almost 9 of them or 10 of them, only one has been sold for further trading. All others have gone for scrap. So if many other ship owners also do this in this fashion, then only will the numbers come down and then markets will go up. In terms of new innovations, you've got the driverless car which has come. You have some accidents with the Tesla model. They've had one death in California, one in China. But I think in the future you will have driverless cars. Similarly, Rolls-Royce is already started experimentation to have a driverless or a crewless ship. Now, whether this will come in quickly enough in the next 5 to 10 years' time is something that we have to watch on a daily basis. But if by usage of big data and the Internet of Things, if we can reduce the number of officers and crew on our ships, then we can cut down on our variable costs, on our fixed expenses. Because if you look at that, more than 50% of our costs are on crew level. So if you've got a cost factor of say 4,500, almost 2,500 of that is just on officers and crew. So if we can reduce that by half through automation and through big data and through Internet of Things, then it will help. And the industry is heading in that direction. So those are the changes that are taking place. And of course we are, as a responsible public company, we are also looking at all of these things and seeing how it will impact us and what can we do to improve our earnings through these innovations.
Excellent. Another question is on the recent international tribunal decision on China Sea. What is the impact if you have to change the route, having more number of kilometers distance?
Yeah. Obviously, if you...
And relevant to this, one news I'm putting you for submission from Australia to UK. Within 2 hours, one superjet has gone. They have used some super fuel, and by which the speed is more. Speed is more, and use of fuel is minimized to the lowest one.
Yeah, I mean, airlines can't compete with ships. Okay. If you look at airlines and ships, I just give you, I won't even go to airlines, but I'll just give you between airlines, between ships, land transport in the form of buses or trucks, and land transport in the form of trains. The cost factor, if shipping costs 1, then a train will cost you 5 to 6 times that, and a truck will cost you anywhere between 8 and 10 times that. If it's an airline, it is 95 times. So even if they can cut down their costs to 1/100th of where they are today, then only they can come and compete with ships. So I don't see that airlines is a competition. So that is the one answer to your question.
China.
In terms of the China Sea,
will be competing. I'm saying you such fuel that is having minimum use and most economic fuel in the world they are using. Name of fuel is not disclosed in the Financial Times, but they say that within 2 hours they have covered the distance. Similarly, ship can also use that minimum cost fuel.
Yeah, we are already doing. So there is already innovation in that area, and of course the engine makers are all working on these type of solutions. So yes, that will come as time goes by. And your South China Sea question, obviously if you choke off any point in the world, say like the Suez Canal as a good example, then of course freight rates will go up very significantly because the same cargo has to travel a much longer distance. Now, South China Sea, I don't think China has done any of these things with an idea to slow down traffic there. In fact, they have done it to keep open the traffic which is being threatened by the Americans. So they're trying to counteract the threat of the Americans by saying that the entire South China Sea belongs to us and nobody can come here, and all our ships will come and carry our cargoes in and out of China. Otherwise, China will close down. If you close the South China Sea, they will close down. So that's their method of trying to keep their trade lanes open. So in fact, what they are doing is trying to make sure that free use of sea lanes is respected. That's what they're trying to do. And they are not trying to stop ships using the sea lanes in the South China Sea.
On economy of China, the recent news said that it is already bottom out and manufacturing indexes are now start improving. What's your impact on the industry?
In fact, as I said, China is trying to come out of the current situation that they are in. See, you must remember, China is an economy in transition. One of the things that Xi Jinping has been talking about is this One Belt, One Road. And just to give you a very short summary of what this means, One Belt, One Road will result in roughly $1 trillion to $2 trillion being spent on infrastructure every year for the next 10 years. Okay, so if that happens correctly, then yes, it will mean a lot of cargoes for us. Second thing is that the One Belt, One Road covers something like 65 countries and 4.4 billion people in those countries, and therefore will increase China's position and power and influence in the world. And that will make them equal to, if not stronger than, the American economy and the America's military might. So I think China is doing all of this from a couple of geopolitical points of view. One is that they want to get more friends on their side, which they will achieve through this long spend. Two, they want to use the surplus steel capacity that they have to churn out very cheap steel, surplus cement capacity that they have to churn out very cheap cement, and use it to create this express rail lines all the way from China to Tehran via the northern part of north of India through the Stan countries, and then another branch will go out all the way via Moscow to Venice. And they've already bought out the port in Piraeus in Greece, so they've already started on this in a big way. Now that is what is you're seeing now in terms of the numbers that are coming out on the macro front for China. I think it is all based on this One Belt, One Road where they are trying to push this thing through. If you wait for the newspapers on Monday, on the Asia Focus segment, you will see a very big article written by me on the One Belt, One Road, and that will give you in very big details as to what China is trying to do and trying to achieve through the One Belt, One Road.
Excellent deliberation. We will be looking for Asia Focus Bank of Post, your article. Thank you very much.
Time's up.
Okay, if there are no other further questions, our time is also up. So I must thank you all for being such a good patient audience and for listening to us and for asking so many intelligent questions. Thank you so much. สวัสดีครับ
สวัสดีค่ะ